Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Diane King Hall. Let's get you up to speed on the market action as we count down to the end of the trading week. We're seeing red arrows across the board. Pretty muted right now, though, with the Dow down 39 points, S&P 500 down about 7, and the Nasdaq down at 64. Now, despite the negativity we're seeing right now, the S&P 500 and Nasdaq seeing their highest levels since April of 2022. We've been talking a lot about that tech rally, and both the Nasdaq and the S&P 500 now headed for their best performance since March of this year. Let's get you up to speed with what's happening in the markets and some of the biggest movers. We've got Yahoo Finance Jared Blickery standing by at the Interactive. Jared.
Well, hello. I was just checking out the Dow's performance this week, and it's looking pretty good. We had a brief dip into negative territory. That was on Wednesday during that FOMC meeting, but for the most part, up 1.4%. I'm sure most investors would take that, especially as we're giving back some of it today. Here's the Nasdaq Composite up 3.4%. By the way, the Nasdaq going to be up 8 weeks in a row. This is something that does not happen that often. Here's the last 20 years. I'm not going to show you every instance on here, but it's only happened 4 times going back to the turn of the century. So this is something we pay attention to. More often than not, about 80% of the time, we see big gains in the weeks and months ahead, with a few exceptions. One was 2010, but I was just writing about that today on the Yahoo Finance blog, so everybody can check it out. Now, here's a 10-year T-note yield. I'm going to go to a 3-month chart so we can see what's up here. Still trading in a range, so no ripples throughout the bond market that we have to be afraid of. Here's the MOVE index at another low at the bottom end of this range here. So just confirming what I just said. Here's the VIX, and we can see that is heading down as well. So equity market volatility, not a big concern here. We want to check out the futures market. I have been tracking natural gas all week, up 3.5% today. You take a look at the 5-day price action, it is up 15%. Now, a couple things in motion here. It is the summer, and in fact, natural gas is used to cool households throughout the U.S. to generate energy for that. So we're seeing warmer weather in Texas. They use about half of their electricity needs. They get that from natural gas, and so that's up right now. Now, you can see over the last 3 years, pretty depressed historically, or relative to the historical prices. We had that huge run up in the middle of last year, so nothing to worry about just yet, but something that we're definitely going to keep on our radar. Just want to close it out, round it out with the sector action for today. A little bit of a defensive setup with utilities and staples in the lead, but over the last 5 days, this is a very healthy mix. Tech, consumer discretionary, that's retail, materials, and industrials. So we got the value trade, we got the growth trade, all of those outperforming. So good week for the markets, guys.
It certainly is. Jared Blickery, thanks so much for that.
Well, the Nasdaq, despite today's performance, looking to close out its 8th positive week in a row, the longest winning streak for the tech-heavy index since 2019. For more on these market moves, we're joined by Ahmed Riesco, Insignio Chief Investment Officer. So, Ahmed, let's get into this market action that we're seeing today. I mean, we've been seeing this tech-fueled rally. We're seeing it extend out a little bit more, well, more than a little bit more. Right now, what's happening? Is this really a game of catch-up? Is this kind of a FOMO play that we've been seeing?
Yeah, if I had to say, or I've had to guess between those two, I would say it's a bit more FOMO catch-up because what you're seeing is that concentration really hasn't spread, or market breadth hasn't increased. This continues to be a story of the leaders leading. And if you look actually at the NASDAQ specifically, the spread between the NASDAQ and the equal-weighted NASDAQ, it's a pretty stretch. In fact, the last time we saw it this stretched was way back in late 2021. And what we noticed that happened afterwards, which is that spread tended to narrow, which means that the other components of the NASDAQ started to gain and the leaders started to lose a little bit of momentum.
Ahmed, we just heard from Jared there, kind of putting the tech rally in historical context. The Nasdaq up 8 weeks in a row. It's not something that happens often. So much of this has been driven by the enthusiasm around AI. Are you a little concerned about how quickly things have run up and to the extent that they have based on a technology or really a single play?
Right, and certainly we have. And I want to sort of preface my statements with saying that we're generally long-term very bullish on this theme of AI. We think it's going to be very productivity and profit enhancing for companies across the board, not just for the leaders over the past couple of weeks. However, if you look back at the dot-com bubble, which is the last time we think we've seen a comparable new technology kind of hit the market, so to speak, you see that there was a lot of froth built into that market, even though the technology, which in that case was the internet, ended up being revolutionary for not just those companies that were directly involved with the internet, but really for companies across the board. So we think this is going to be a very similar setup to that scenario back in the early 2000s.
So you see this as an AI bubble to you, Ahmed?
I don't think we're quite there yet. We tend to have pretty strict parameters mathematically as to what we define a bubble as, and we're not there quite yet. It's funny because you look historically, whether you're talking about the dot-com stocks of the 2000s or the Dutch tulips of the 1600s, you see that mathematically they all look the same. It doesn't really matter what the underlying asset is, and we're still not there yet in the AI. So this still has further potentially to run.
Yeah, I mean, let me follow up on that. Anytime there's a comparison to what happened in the early 2000s, that's going to raise alarms. I mean, are you suggesting that things could end similarly to what happened then?
Well, part of and we want to make this clear, there is a completely different setup right now, right, in terms of the macro environment. In fact, the economy right now is on pretty solid footing, although we do think that down the line over a 12-month window, the probability of a mild U.S. recession is quite high. So we're not necessarily calling for similar type of market action. Remember, we also had a massive sell-off in that space just last year. So those markets or these markets aren't currently as expensive as those were back then. So unlikely to see a similar setup.
Well, we did get some more Fed speak today with Fed Governor Christopher Waller saying he doesn't support altering the stance of monetary policy over select bank fears. The commentary comes after the Fed announced they were holding rates steady on Wednesday as they leave time to, in their words, assess additional information. At the same time, Ahmed, we got this University of Michigan Consumer Sentiment Index, which really showed inflation expectations being drawn down significantly. We're now talking about 3.3%, which is a big drop from where we saw it in May. What does that leave the Fed?
Well, to be quite honest, we think the Fed has already gone a bit too far, which is why actually we think the Fed's action could potentially have increased the chance of a recession. We think that had they kind of stayed their hand a few meetings ago, I think there would be an increased chance of achieving this soft landing, of threading the needle here. But the fact that they remain insistent on increasing rates, despite the broad-based evidence right now that we're in a pretty strong disinflationary trend. True, core inflation is not back to where the Fed wants it to be. But as with always, we don't want to look at where inflation is today. We want to see to where it's headed. And most of our indicators are pointing to a pretty strong disinflationary trend.
So, Ahmed, do you think by the time the Fed meets again, I know, again, this has been a data-dependent Fed, and the signal has been that there's the possibility of 1 to 2 more hikes this year. But do you think that if you were to give your opinion to Chairman Jerome Powell, that they should hold the line at the next meeting?
Yes, to be quite honest, like I said, I would have probably told them that at the previous meeting, but obviously the Fed is not paying me right now to give them advice. But look, the Fed makes mistakes all the time. In fact, they more often than not tend to over ease or over tighten. So this would not be something shocking to anyone who's been a watcher of the Fed or an observer of economic history. It's much more often the case that they make a monetary policy mistake. We think that they're dangerously close to that at this moment.
In many ways, I mean, could you argue that the Fed is just expanding their options here by sort of dangling the potential of those 2 additional rate hikes by the end of the year? In addition to Christopher Waller, we also heard from Richmond Fed President Tom Barkin today, who essentially said that he's not convinced that inflation has started to draw down when you look at core inflation. I mean, that seems to be a disconnect from what you're saying, that disinflation, we are starting to see the disinflationary pressures already kick in.
Yeah, because remember, these inflation numbers, especially when you're talking about PC and CPI, they're very backward looking. So they're looking at data and they're reflecting the macroeconomic environment as of a few months ago, even in some cases. So I do have some sympathy to your point in the sense that I think the Fed might be trying to verbally intervene here into markets to actually not have to raise the rate at this point. But I think by all accounts, I think by even the most aggressive estimates of where the neutral rate is, I think we can clearly say that we are in restrictive territory at this point, and we are already starting to see signs that this is filtering through into the economy. So for them to keep further pressuring ahead, especially when we haven't seen an uptick in long-term inflation expectations, remember, those remain pretty well anchored. So we really see no reason for the Fed to continue. However, given their rhetoric and given what they've been telling us, we are expecting them to.
Ahmed, I want to switch gears a little bit and take a look at the broader market again. So we have a strategist who's predicting that the current market rally may be short-lived. This is Bank of America's Michael Hartnett. Now, he's warning that the signs pointing to a big rally before a big collapse. Now, he got last year's sell-off correct. What do you think about his point that, you know, this is kind of just a brand new, shiny bull market, but it's going to be short-lived?
Well, we also do have some sympathy to that view. A lot of that is going to really depend on what happens with the economy. It's impossible to have a sustainable bull market before a recession has even begun, right? Because the earnings pressure on companies is going to increase going forward with the subsequent uptick in unemployment. So a lot of this is going to depend on what the forward path for the economy is. If the Fed is somehow able to thread this needle and avoid a recession, avoid over-tightness into a recession, this market certainly could be the beginning of a new bull market, and it could potentially be even longer than what he suggested. However, our indicators are pointing to heightened probability of a recession over the next 12 months, which means that we remain skeptical. Now, I do want to highlight something. We do think, though, that downside risk is quite limited because the recession that we're looking for is a pretty mild one. In fact, in some sectors, in some households, in some parts of the country, it might not even feel like a recession. So we are looking for only a minimal increase in the unemployment rate.
So what does that ultimately mean from an investment standpoint? How do you get out ahead of that? Do you stay in some of those growth names we were talking about, or is it more about the value play, potentially small caps?
Yeah, so we've actually shifted our portfolios recently, given the fact that we actually anticipated this rally to start the year. The S&P recently reached our target. What we've done is that we've done a quality shift into our portfolios. And what that means is that we've increased our exposure to companies that have high quality factors. And these are companies that have high profitability because they have a high return on equity. But at the same time, they have very low leverage and they have low debt to leverage ratios. And these companies tend to perform better in environments with higher rates and slowing growth, which is precisely the environment that we think we're going into. We don't think rates are going to necessarily creep higher from here, but we do think that they will stay longer than what many previously anticipated. That is a great environment for quality.
Ahmed Riesco, Insignio Chief Investment Officer. Appreciate you joining us on this Friday.
Thank you.
All right, we are just getting started here on Yahoo Finance Live. Coming up, U.S. Secretary of State Antony Blinken is set to make his first trip to China under President Biden. What this means for U.S.-China relations, that's next. Plus, a tentative deal between West Coast ports and workers eases strike fears. We'll speak with Port of Los Angeles Executive Director Gene Soroka, and why it may not be the best time to be checking your 401k. Talk with a panel of experts. That's coming up this hour.
Secretary of State Antony Blinken making his first trip to China. Blinken's visit comes as tensions between the two countries is running high. And while the U.S. looks to de-risk its relationship with China, the hopes of a breakthrough remain up in the air. Here with more on this, we have Wiley Ryan partner Nasdaq Composite. Nasdaq, it's good to talk to you today. Look, the White House has set the bar very low for this meeting, essentially saying that this is about just restoring the communication lines, opening those back up. What would you consider a success out of this visit?
I mean, I think the first threshold question is, are we going to be successful? Is this meeting going to actually ease tensions or prompt some type of reconciliation? And the answer is no. And this is not about Secretary Blinken. No one can be successful because the Chinese government views the United States as an adversary, as an enemy, and it's not interested in improving or thawing relations with the United States.
Nasdaq, but what about, I mean, in some ways it seems interesting, at least in improving business/economic relations when you think about the executives that China has been courting. What are your thoughts on that?
It's, you know, I've been working on the China issue, the China economic competition, economic war issue for 20 plus years. With China, it's a one-way street. They court companies in. And they extract what they need to. And then when it's convenient for them, they shut them out. So, of course, we're not surprised that we're seeing hoarding of U.S. companies, but that's because those companies have something to offer that's in the Chinese government's best interest. And when they're done with them, they'll get rid of them, as we've seen.
So if we take Bill Gates' recent visit with President Xi himself, what's the motive here? I mean, if you talk about trying to extract something, why meet with Bill Gates?
Look, Bill Gates has business ventures that are very important to the Chinese government. And so they want to signal, especially to the major corporate leaders of America, that, look, China's open for business. Come on in. We're happy to do business with you. And what better person to start with than Bill Gates? They've been courting Elon Musk. We just saw a recent trip. It's a signaling tactic, but at the end of the day, they will bring companies in. And we see the forced joint ventures, the transfer of IP. We've seen this story over and over again. And I have yet to see any company that says work going in China is going to be a success story in the short, medium, and long term. Every single company acknowledges that in the long term, the prospects in China of success in China are very weak.
Speaking of companies that have kind of been under scrutiny in the spotlight, let's talk about TikTok. I mean, you know, there's been talk of a ban on TikTok. It's kind of seemed to take a backseat to these AI conversations within the government and them looking how to manage or regulate that. Is TikTok now, is the potential for an all-out ban still on the table from your point of view?
Absolutely. States are progressing with the bans. We just recently saw, just on June 2nd, a ban on federal government contractors using TikTok and devices that sort of intersect with the work that they do for the government. So the government is getting more and more hawkish. Congress is preparing to move forward on more aggressive legislation, pushing forward the legislation that they have. So this is not dying yet. And we see states are now in litigation with TikTok with respect to the proposed ban. And so the TikTok issue isn't going to die out, where I just expect us to see more and more movement in the months ahead.
And Nasdaq, I want to get back to the earlier point you made about Bill Gates and that meeting with President Xi. I mean, certainly President Xi has been looking to court some of those leaders, business leaders. You mentioned Elon Musk as one, but I mean, couldn't you argue that China is in a bit more of a vulnerable position right now when you consider the economic recovery simply hasn't picked up the way they expected or they wanted to post-pandemic?
Yeah, I think we have to be careful about looking at today in an isolated incident versus China sort of courting businesses over years and decades, right? China's strategy of courting U.S. businesses, global businesses over the years and decade, has been to extract IP, to extract know-how, et cetera. And so we see it now, but we have to understand and we have to remember that we can't take this as an isolated incident, right? Yes, it aligns with the time that China's trying to recover post-COVID, post the zero COVID policy. But when we look at this in the broader context of the continuum of courting, right, there's one reason for the courting. The Chinese government has been explicit about this, to lure businesses in their territory so they can get the know-how, get the IP, build their own economies. And then again, once they're done, the Chinese government isn't shy about then exempting companies from being able to grow within the Chinese market.
Yeah, and on that front, we heard from the Commerce Department this week, blacklist 30 additional Chinese companies for selling U.S. IP to the Chinese military. Look, let's talk about where the Biden administration's policy is right now, because on the one hand, we're hearing we want to keep the lines of communication open. At the same time, we've heard from the likes of Jake Sullivan, the national security advisor, say we are trying to de-risk here, not necessarily decouple, but de-risk, bringing manufacturing back onshore, protecting our IP and technology. How do they navigate that very delicate line in this meeting?
I think the only way to do it is to kind of have these dueling inconsistent narratives, right? We're very, very concerned about China's control over supply chains, China's control over chokehold supply chains. So we have to reshore. We're also working to make sure that all of the technology we've already given up to China, they're not able to run faster and capitalize on even more technology growth. So we're restricting exports of high technology transfer goods to China. At the same time, we're saying, look, we're doing this to protect our own self-interest. And much the same way, I want to emphasize that China is taking measures to restrict access into their markets, to restrict investments into their markets, to restrict our technology, our companies from being able to access their consumer base. They're doing the same thing. So yes, we're saying that there's certain areas where we want to trade and we want to continue business relations, but for interests that are vital to our economies, vital to our militaries, look, we need to be independent, just like you've built your own independence, China.
Okay, well, we'll all be seeing what comes of this meeting. Nasdaq Nikakhtar, Wiley Ryan partner. Good to talk to you today. Appreciate the time.
Very good to see you. Thank you for having me.
Meanwhile, Bud Light's parent company Anheuser-Busch is trying to reassure business partners and the others the ongoing boycott over the brand's partnership with transgender influencer Dylan Mulvaney. CEO Brendan Whitworth writing a letter detailing how the company will take care of its wholesalers. Yahoo Finance's Brooke DePalma has that story. Brooke?
Good afternoon. I mean, surely this is a saga going on now to the third month. We know that Anheuser U.S. CEO Brendan Whitworth writing in a blog post on Thursday that over the last 2 months, the discussion around the company and Bud Light has moved away from beer and impacting consumers, businesses, and partners, and as well as employees. He reiterated in that post that they are a beer company and beer is for everyone. He also outlined a plan, what he believes that will steer the company in the right direction. That includes investing to protect the jobs of frontline employees, providing financial assistance to independent wholesalers and to customers. He said, quote, "We hear you." He also noted that summer advertising launches next week. It's important to note that we heard in the earnings call back on May 4th that they plan to triple their media marketing spend this summer. And as we reported earlier this week, this plan, this idea of how they're going to steer the company right that we're hearing now from the U.S. CEO comes after they lost the top spot in the last 4 weeks. Of course, we know that Modelo is owned by Constellation Brands, and now Modelo holds about 8.4% of total retail sales in the U.S. beer market. That's compared to, as you see here, 7.3% of the total share that Bud Light now holds in the last 4 weeks. But sales for Bud Light continues to trend lower year over year. During the week of June 3rd, Bud Light saw a 24.4% drop in sales. Modelo increasing sales year over year, 12.2%. Budweiser, another Anheuser-Busch brand, seeing a drop as well, down more than 7%. Coors Light also gaining share, up nearly 26%. So certainly this is a saga that we continue to tell and continues to hit Anheuser-Busch's sales.
Yeah, Brooke, I mean, that chart you just showed pretty much tells the story and the struggles for Bud Light. What's been the reaction to this letter so far?
Yeah, well, I spoke to quite a few marketing professors this afternoon, and some professors telling Yahoo Finance that the company is sticking to just the product here and shying away from really taking a stance. One professor from Drexel University saying, quote, "This, I think, is sidestepping the thing that is bothering many consumers the most, which is what they're not finding a coherent message about what the company stands for." Now, he went on to say that this statement does suggest that they're trying to move away from the values discussion entirely and focus on that product itself. Now, another professor from Georgia College and State University who actually teaches an LGBTQ plus marketing class pointed out that we haven't seen those rainbow bottles that they've partnered with GLAAD, the LGBTQ advocacy group, in the past since 2019. Then with this partnership, they were fundraising for this organization. Well, we haven't seen them this year, as that professor noted, and I went out to GLAAD to see if we might see it in the rest of this Pride Month, and they said we will not. It's worth noting as well that the GLAAD CEO did write an op-ed sort of expressing her disappointment in the way that this all fell out. So lots unfolding here, and we'll continue to watch it as it does.
Yeah, indeed. And one thing also of note with regard to that letter was it was somewhat of a mea culpa, but without a full apology. So,
right.
You know, and certainly seeing as the market value of the company drops,
right.
You know, having to respond.
Yeah, Anheuser-Busch continuing to say that we're a beer company, we're here to serve everyone, and so really sticking to that stance here.
There's a little bit of a pun there, too. Brooke De Palma, thank you so much. All right, coming up, a tentative deal between West Coast ports and workers have eased fears around a strike. We'll speak with Port of Los Angeles Executive Director Gene Soroka to get his take. That's next. Stay with us.
Tesla up 25% over the last 10 days. In fact, year to date, this stock is up a whopping 108%. Part of this has to do because of AI. Adam Jonas over at Morgan Stanley writing a note recently saying that investors are thinking of Tesla first as an AI company and second as an automobile maker.
The story about Tesla has been about their moat, about their investment in technology, their autonomous driving, how that database really gives them an edge over their competition because they don't want to be valued like GM or Ford or Volkswagen. They want to be valued like a tech company because that gets the stock price higher. If Tesla is an AI story, guess what? That's a bubble story. And so I would just take that to mean, okay, Tesla is going to be part of the next bubble.
The reason why robotaxis could be so transformational is the deals that they've struck with Ford and GM, basically opening the supercharger network, and effectively these two OEMs coming to Tesla and choosing their platform. Elon Musk said on his shareholder meeting, he said flat out, like, we want to be like Android and really open up this software to everybody.
The whole thing that's fascinating to me is the real transformation in this industry where everybody, right? Ford, GM, Stellantis, Ferrari, Volkswagen, they're all leaning into this EV transition. The industry's moving that way. I just think that, it's possible that it might take a little longer than expected to hit some of these forecast numbers that are out there.
After 13 months of negotiations, West Coast ports and the dock workers union have reached a deal. It comes after ports stretching from Seattle to LA saw terminals temporarily close, work stoppages, and government intervention. Just last week, President Biden's Labor Secretary Julie Su waded into the debate and pushed for a resolution, which eventually came on Wednesday. That includes a 32% wage increase for workers over the next 6 years. Many retail associations are breathing a sigh of relief, as is our next guest. That is Jean Soroka, the executive director of the Port of Los Angeles. Jean, we started this conversation more than a year ago. In terms of the negotiations that were happening, how instrumental was the White House, specifically the Labor Secretary, in helping reach this deal?
Good afternoon, Akiko. Good to see you. Julie Su's presence was absolutely critical in getting this deal over the finish line. Please remember, she was the California State Labor Secretary for a number of years before moving to Washington in the capacity of Deputy Secretary of Labor. And now as acting and appointed to go in front of the U.S. Senate for vote on the permanent job, she's known both of these parties very well over the time that she's worked with them. And this dialogue had been ongoing. She didn't just parachute in at the last minute and try to influence the negotiations. These are partnerships she's developed over a number of years. And she was holding weekly calls with both parties, talking individually on the phone during the past several months. And it was determined by some of us that it was probably time that she visited with the folks face to face. And for those 3 days in San Francisco, she was able to do shuttle diplomacy, get the two sides together on critical issues, and come out Wednesday night with a tentative agreement.
And Jean, so we saw that there was this 32% pay increase that you got in the deal, the one-time hero bonus as well. So kudos to the workers for that. What else did you secure from the deal, and are you happy overall with it?
I'm pleased. And as the Port Authority in Los Angeles, I'm not at the negotiating table. But as a former Pacific Maritime Association board member and working with both sides regularly, as well as the White House and Julie Su herself, we kind of see how this was beginning to develop. And it was imperative that these workers get paid what they're worth. They were out on the job on average 6+ days a week during the pandemic when we had that unbelievable cargo surge for 2.5 years. They really kept the American economy moving. At the same time, the companies have to be competitive now as we go to our next step, and that's to try to bring some of this cargo that's moved away from us back here to the West Coast and specifically Los Angeles.
So let's talk about that. When you look at cargo volume, they're down 27%, at least in the first 5 months of the year compared to where you were last year. A lot of that has been diverted to the East Coast ports. You've said before that you're not sure all of that can come back. What do you do now to bring them back?
It all started this week. I was up in Tacoma, Washington, Akiko, at the annual Agriculture Transportation Coalition meeting, their 35th meeting led by Peter Friedman, talking with about 450 members of growers, farmers, producers, canners, and trying to share with them the ground truth of what's happening here in Los Angeles. And now that we have the solidification of a collective bargaining agreement, trying to build their confidence in bringing cargo back. It's my estimation that about 15% of our normal cargo has moved to the East and Gulf Coast. The balance of the decline that you just mentioned is based on the economy. Inventory levels are still very high today, whether it be in finished retail goods or manufacturing parts and components. We're starting to see a little bit more momentum in cargo coming across the Pacific. There are about 58 ships on their way right now, and that's the highest it's been in several months. I think that we'll get on a more normal cadence of cargo flow in the second half of the year. And with this deal and the continuing move forward of the U.S. economy, I think we're going to have a better second half than we saw in the first 6 months.
So that's an optimistic view, Gene, but let's play the other side of the coin in terms of there's still expectations for at least a mild recession. What does that do to the ports if that is something that we should see this year?
Yeah, Diane, I know this has been talked about now for seemingly 2+ years from experts across a wide variety of industries in the United States. I just don't see it. Again, by textbook definition, it's 2 consecutive quarters of GDP decline. We already saw that back in 2022. Now, again, looking at the economy and its equation today, it's kind of unique. 339 jobs were created last month. Inflation has come down 11 consecutive months, annualized at 4% with the last report. 3.7% unemployment rate, the lowest since the late 1960s. And what was even more encouraging are the last 2 months of retail sales. While many of us are spending more in the service sector, every airplane I'm on is full, the restaurants are packed, and people are going back out to the baseball games again. But our economy keeps moving along. So we're going to keep watching this closely. As a leading indicator of the U.S. economy, I can tell you right now that we're seeing a lot of cargo come across the Pacific. And the other thing that I'm not seeing are canceled purchase orders. Typically, these orders go into factories in Asia 90 to 120 days before a vessel departs, and I'm not seeing levels of cancellation that would cause me concern for the back half of the year.
Gene, we always like to ask you about what's happening over in Asia, just given where your cargo comes from. We saw the PBOC yesterday over in China cut their medium-term lending rate. The economy, the recovery in China simply hasn't taken off as quickly as expected. You're on the receiving end of some of that cargo. What does that look like to you right now from your vantage point?
Yeah, orders so far in the first half of the year at Kiko, as I mentioned, have been very light because of the inventory levels that remain here in the warehousing complexes across the country. The St. Louis Fed has said our inventory sales ratio is above 1.30. The folks that manage this part of our supply chain like to see that inventory sales ratio about 1.1, 1.15. And if you're like me, you're getting emails and texts every day from your favorite retailers offering deep discounts on inventory. So we've still got a ways to go to push those products out of the domestic warehousing system before we're really going to kick it in gear on new imports coming in. But again, I like where we stand. Summer fashion, back to school, and fall fashion right now are looking like they did a little more traditionally before the pandemic. And it's going to be up to a big year-end retail holiday season to define what the overall year is going to end up like.
That's why we always like to get your perspective there. Gene Soroka from the Port of LA. Good to talk to you today. Have a good weekend.
Thank you, you too.
Meantime, President Biden set to appear in Pennsylvania at a union gathering for his first political rally. As Biden gears up for re-election, here to discuss, we have Yahoo Finance's senior columnist, Rick Newman. And I love your wave, Rick. It's interesting that we're just speaking about a labor issue. And of course, Biden now reaching out to a good part of his base.
Right. Biden won the union vote 57% to 40% in 2020. He didn't crush it. Democrats, there have been some elections where Democrats could easily count on the vast majority union vote, and that is not the case anymore. Donald Trump actually had a pretty strong appeal to unions, and that is a very important place for Biden to start because if there's any core Democratic voter base that Biden needs, that would be it. So he's going to start to make this pitch. He's got a lot he can offer to the unions. He has a lot of the bills that he's gotten through Congress, like some of the green energy credits or things like that in the Inflation Reduction Act. Those jobs, to get those credits, you have to employ union labor. So that's one thing he'll be bragging about. He also just needs to talk up the economy in general. I mean, we have a really strong labor market, but we have consumer confidence that is, by some measures, at recessionary levels, and that's because of inflation. Right. So he needs to get out there talking about what's working in the economy, and also hopefully get a break on inflation down the road, because that is really putting Americans in a sour mood.
Yeah. Rick, to what extent is that union vote in play in this election? I mean, we know President Biden talks about it a lot, but on the other side of the aisle, who's competing for it?
I think it's in play, Akiko. At least enough of it is in play. Who is competing for it, of course, depends on who the Republican nominee is. But if that Republican nominee is Donald Trump, I mean, who knows what's going to happen with Trump facing all these lawsuits and criminal charges. But, Trump appealed to unions. And let's remember, what really matters with the vote is not how it splits on a nationwide basis. It's how it splits in swing states and even in swing cities. Think about what some of the swing states are. Michigan, Pennsylvania, Ohio, heavy union representation among voters. Picking up a few thousand union votes in a key city in 2024, I mean, we've had really close elections the last couple times around. That could be decisive.
Okay, and I know you're going to be watching that one closely.
Oh,
Rick
yeah.
Newman, as always, thank you.
See ya.
Well, coming up, why now may not be the best time to take a look at your 401k. We're going to get some commentary from two key experts. That's coming up after the break.
Bonjour! The French Riviera may be famed for playing host to an annual star-studded film festival, beautiful aquatic scenery, and fine cuisine. But for 1 week, hundreds of billions of advertising dollars are at stake. It's the biggest gathering in marketing, media, and tech space. Cannes Lions and Yahoo Finance will be there, talking with C-suite execs from the household brands we all know and love. We'll also speak with some of the biggest profiles in entertainment, such as Cannes Lions 2023 Entertainment Person of the Year, Kevin Hart. Plus, international music artist and producer, will.i.am. 3 big themes coming your way. 1, generating demand during a discretionary spending downturn. 2, leading a values-driven brand through a polarized society. And 3, the role of artificial intelligence in advertising. Join us at the Cannes Lions Festival all week on Yahoo Finance.
Well, stocks are back in bull market territory, and that has many rushing to check their 401k balances. But our next guests say that's the wrong move. Joining us now, Sarah Newcomb, founder of Thrive Financial Empowerment Center, and David Blanchett, PGIM head of retirement research. So let's get right into this. What is wrong with that? We'll start with you, Sarah, and then you, David.
Yeah, I mean, when markets are down, we say don't check your balances. When they're up, we're saying don't check their balances. You'd think we'd say don't ever look at it. And it's not that checking your balances is bad. It's that frequent checking your balance can lead, it puts you at risk of making emotional decisions. Because the more frequently you check, the more you're going to feel every up and down of the market. And that just puts you on an emotional roller coaster ride, which we know doesn't end well for most investors.
Yeah, so don't necessarily move with your emotions here. Look at the timeline. David, my question is, if you don't make a knee-jerk reaction, could it be potentially a time to maybe shift up that portfolio a little?
So it might be. I think that, Sarah's point's really valid, where, you can't control what the market does, right? So focus on things that you can't control, how much you're saving for retirement. And, right now is a different, unique environment where the markets are up quite a bit. We have a very attractive return on fixed income or cash. And so, while I normally wouldn't suggest that you regularly check your balance, I think right now, to the extent that maybe you're on track to retire successfully, it could actually make sense to make a move. Now, again, I think, take a deep breath, don't make big changes. But if you're on track to accomplish your goal, your retirement goal, maybe take some risk off the table might not be a bad idea.
Sarah, I got to ask you, okay, so to your point earlier about don't check bad, don't check when it's good. So I am one of those people who has been guilty of when things are great, because I used to check when it was bad. I stopped doing that. I do like to check, when should I be checking my balance then?
Yeah, I mean, I'm with you. I like to check too, but I check periodically when I know I've made a contribution, because in that way I'm reinforcing the savings habit. I'm rewarding myself by watching my balances go up. I think the risk that you run by checking during a bull market is that then you anchor your expectations on peak estimates of the values of your assets, and it makes more normal times actually feel like losses, because then if you're checking during a peak and then things fall a little bit, rather than it feeling like, well, things are back to normal, you will feel as if you've lost money. So that, I think, is the biggest emotional risk of checking during really peak performance days, is that anchoring on that peak amount. But it's great to reward yourself for saving. I would say there's no realistic need to check more than a few times a year, quarterly, maybe at most. If you are in a long-term investment position, there's no reason to be checking every few weeks.
Yeah, Sarah, that's a good point about sort of anchoring expectations here. A lot of people thinking that with the tech names, especially that had such hyper growth during the pandemic. David, you pointed to potentially, and of course this all depends on your timeline, taking risk off the table right now. What does that strategy look like?
Well, again, like normally I don't like the idea of market timing. I'm not actively suggesting that, but I think that we're in a really unique environment today where you can earn 5% for doing nothing, having your money in cash. And so, if you're one of those people who are kind of hyper obsessed about retirement, you're checking, often you're kind of feeling the pangs of that up and down, taking money off the table. Normally there's a big cost there, right? Normally cash is returning nothing or 1 or 2%. Well, if you feel like you've reached a comfortable spot, right? Things could always change. If you're invested in the markets go down. We saw that in 2022. I think it is worth asking yourself today, hey, like, have I gotten far enough? Am I close enough to my goal where moving some money into like cash or high yielding bonds could actually make sense? So again, I'm not suggesting market timing, but I am suggesting think about your situation and what's attractive right now.
David, I got to ask you though, so you're not suggesting market timing, but a follow-up to that would be then how do we stop people from getting off the roller coaster in the middle of the ride?
Yeah. So again, I'm suggesting like this timing decisions based upon your overall financial situation. It's not like where markets are going to go. I think that we've done a lot of that already in terms of like 401k plans with things like target date funds. I think that you need to understand that so much of what happens in the market is noise versus signal. Like markets go up, markets go down. I think that the key is delegating your account to a professional manager. And then as Sarah said, check in once a month. I mean, no, not once a month, once a quarter and leave it alone. Like the best thing you can do for your retirement is to stay the course and invest regularly.
Sarah, really quickly, in times like this, what's the biggest question that you're getting right now?
Well, I think I really love what David is talking about in terms of the checking against your goals, because regardless of the market performance, whatever the question is, the underlying question is, am I going to be okay? Do I have enough? Will I have enough? And if you've done the work with a professional to make a plan so that you know where you would need to be right now in order to be on track for retirement, then you can check your balance against that benchmark. And you're not benchmarking against what the S&P 500 did. I think you always have to ask yourself the question when you're looking at your balance, what are you comparing it to? Yesterday, last week, where you need to be? And so if you're looking at where you need to be right now and you're far above that, then yes, you're ahead of your goals, and now may be a good time to lower your risk and take advantage of some of those gains. And yet, I think what it always comes back to is that if it's frequent checking, then the need that you might be meeting may be more of a need for control, in which case checking on market behavior is not going to meet that need. Focus on the things you can control, like your cash accounts.
Sarah, you haven't fully convinced me yet. I'm still in the guilty camp of probably checking too much. I'm sorry. It's just, it's when you grow up a certain way and things change, it's hard to go against the psychology of, kind of the emotional. I mean, we see this in trading activity, the FOMO trades and things like that. We're going to have to put a pin in our conversation for now. Maybe we'll do a sidelines conversation where you all can convince me. I'm sure there are others that need more convincing, but we appreciate your insight. Great advice, Sarah Newcomb and David Blanchett. We appreciate you all today. Meantime,
many Americans are deluding themselves when it comes to retirement readiness. That's according to a new study from the Center for Retirement at Boston College. They found many of us have a good gauge on our financial situation, but we may have the blinders on when it comes to what happens once we stop working, especially for those with greater wealth who may be too optimistic about how far their savings will actually go. Yahoo Finance's Carrie Hannon has been digging into the data of the report. Carrie, I feel like we've created an entire segment that's making us reassess our retirement plans.
Absolutely. I mean, it's a little bit of a disconnect here, what this study is showing. And first, let's define what they mean at risk. And what they mean is that you're not going to be able to replace your pre-retirement income. And so for higher income people, it might not be as drastic. They may just have to do some great deal of downsizing. For lower income people, this could be quite dangerous for them in terms of even meeting necessities. So what they found, the researchers found that, a third of people say they're at risk, but the researchers say it's more like half of people, of Americans, are at risk for not having the preparation to replace their pre-retirement income. And so that's something that's very concerning, because that means that they're not making these course corrections that they need to make in order to accumulate that. But what I found really interesting in this study is that they say it's the higher income people that are the most optimistic, and delusionally so in many ways. 1 in 4, the researchers say, are actually at risk, where only 17% are concerned that they are. And there are a couple of explanations for this. The one reason might be because they own a home, right? And they think, well, I've got plenty here. I've got this home. But they're not figuring in what they still own on that mortgage, on the debt level there. The second thing might be that they have, oh my gosh, I've got $100,000 in my 401k. That's sufficient. But if you really peel that down, that's only going to come to maybe $617 a month. So that's not a huge stash away amount. And the third thing is, often you'll have a dual career couple, but only one is really aggressively saving for retirement. So if you only have one saver, it's going to be pretty hard to replace that pre-retirement income. So they're probably not going to go broke, mind you, but it is something they need to pay attention to. So I found that all really quite interesting.
So, Carrie, I got to ask you about the feeling factor in all of this. The study looking into how many of us feel we have a handle on our finances. What about this gut sense? What stood out?
Yeah, don't you love it? The thing is, we're all harped on like weird financial literacy is so bad. And of course, that is a real issue in America. But the researchers found that, roughly 3 in 5 people have a good sense of whether they are at risk or they are not at risk. I mean, there's this intrinsic knowledge that something's afoot. So that is actually quite encouraging. The other piece of information I found in the study that's worth noting is that 15% of people were too worried. And what the researchers say why that could be a problem in many ways is because you're sacrificing living today. So to end on sort of a positive note, if you're worrying too much, take a breath.
All right, Carrie Hannon, great advice. Thank you so much. Coming up, we've got the closing bell on Wall Street, plus some top trending tickers we are watching to close out the week. Markets looking like they'll finish the day in the red, not necessarily the week, though. Stay with us.
And welcome back to Yahoo Finance Live. Red across the board here as we close out the week on Wall Street with the Dow down 100 points or just over 100 points, the S&P 500 down 16 and the Nasdaq down 92 with investors taking a bit of a pause here, just like the Fed earlier this week.
All right.
And there you have it, the closing bell for this week as investors head into an extended weekend, we should say. Market closed on Monday because of the Juneteenth holiday. The S&P 500 and the Nasdaq now seeing its best performance since March of this year, and red across the board here. But in terms of the week, certainly a positive week to round things out. Well, SoFi shares are making a move to the downside after several analysts issued downgrades on the stock. Bank of America and Piper Sandler downgraded the company to neutral. This coming after Oppenheimer also downgraded the stock, citing issues in valuation management and credit quality. And Diane, this is just yet another one after the incredible run-up that we saw in shares of SoFi, more than doubling over the last month. It seems like valuation, certainly one that we've heard over and over from analysts, although the case for upgrading the stock has been sort of the overhang from the student loan pause being removed.
Exactly. Like the B of A note didn't seem bearish about where their status was on it, downgrading it to a neutral. They say because of the move over the 100% move over the past month compared to a 7% increase in the S&Ps. So that's what it's more about, the valuation there. And they believe that the federal student loan payment, like moratorium, is priced into shares. So it's, again, as you mentioned, this valuation play. They see the moratorium on student loans as accretive to SoFi, but that it's already baked into the numbers already. So that these kind of sky high expectations that SoFi has been having is baked into the news. So you see this as sort of the buy the rumor, sell the news situation. Not that it was a rumor. We know this is happening. So you're seeing that get dinged today, though. On the flip side, though, Virgin Galactic shares flying higher, surging nearly 17% as the long wait for its first commercial passenger mission appears to be coming to an end. The space tourism venture announcing plans for the flight takeoff as soon as June 27th. So, Akiko, this is, of course, one we've been watching for a while with Virgin. I mean, we know that they've been trying to head into space for a while with regard to space tourism, selling 800 tickets. Those were pricey tickets, if you remember.
Yeah, I mean, a backlog of 800 passengers is what we're talking about. So, yes, they are certainly ready to go. And Virgin Galactic now going to be taking these trips monthly. That's always been the plan, but they have been delayed one after another. We should point out, by the way, this isn't just a leisurely trip for billionaires. The first trip is going to be members from the Italian Air Force and the National Research Council of Italy. They're going to be going into the edge of space to conduct what they have described as microgravity research. The stock, by the way, though, has lost more than 90% of its value since that very public trip that Richard Branson took last year. So certainly looking to gain some momentum here on the back of that, at least for one day. Positive news coming through with that stock up about 17%. Well, Tesla shares in the green as CEO Elon Musk suggests the company's market cap is tied to the automaker's ability to solve autonomous driving, to which I say, Diane, this is what we've been talking about, right? We had an analyst on yesterday saying, yes, it is about autonomous driving. By the way, though, I mean, it is worth noting that he's been touting this for some time, this fleet of robo-taxis, self-driving cars, all the Tesla owners. That first timeline, he said, would be 2020. And here we are in 2023.
I know. But to be fair, I mean, clearly Wall Street's still in love with Tesla. I mean, yes, it hit a speed bump yesterday, but it picked right back up basically where it left off. I mean, diverging from the broader market. I mean, Tesla's been a leader in this tech play, or even the AI play, as you would say, as some say it is an AI company. We've talked about this before, but, you know, so certainly the leader there. And then they, of course, have the charging relationships, these joint ventures that Tesla is doing that's helping just kind of beef up its footprint, not just in autonomous vehicle driving, but the charging networks as well. So being kind of the leader in the tentpole charging station for the EV space, Akiko.
Yeah, and that transitions us nicely into this conversation here with U.S. EV sales soaring in Q1. It was up roughly 80% since last year, according to research from Counterpoint USA. Despite the rising popularity, though, range anxiety remains a huge hurdle for many potential buyers. Roughly half reject the idea of purchasing an EV because of the lack of charging stations that are available right now. At least That's according to JD Power. Now, finding a charging station could get a little easier. Diane pointing to those partnerships with Ford and GM and Tesla, now giving their own EV owners access to Tesla superchargers. For more on this, let's bring in Brendan Jones, Blink Charging President and CEO. Brendan, we saw your stock get hit in a big way on the back of that partnership being announced. What are shareholders missing right now? What does this mean for Blink?
Well, I think they're missing for Blink and for other companies that actually Tesla's our #1 customer today. So if we look at who plugs into our chargers on a daily basis, it's overwhelmingly Tesla drivers. Now that, of course, corresponds to their market share. But the reality is this, is that the majority of charging takes place on what's called level 2 charging. And the announcements that came out from GM and Ford respectively with Tesla is all about DC fast charging. So DC fast charging makes up about 10% of the space. So Blink is about 95% a level 2 company and then 5% a DC fast charging company. So we're going to wait for the dust to settle on this. We are excited about the announcement by Tesla. It means that, as you said, there's range anxiety, but we believe installing reliable EV infrastructure creates range confidence, and that's our job. And we believe that all ships rise together. So we're going to keep investing in L2, and we'll even start producing DC fast chargers that have the Tesla standard on it.
Yeah, I mean, let's pick up on that point. I mean, yes, you're saying you're waiting for the dust to settle, but you do have NACS chargers as well. Does it matter what the standard is? Because it feels like the market has been fragmented already.
So the market has been fragmented a long time because before you had CCS, you had CHAdeMO. And then you had CCS and CHAdeMO, now you've got CCS and Tesla. So we've been in this constant state of flux for a while now. So what we have to do is make sure that we equip all stations with the ability to charge all the vehicle types out there. And eventually it might settle down, but for the near future, because both the GM and Ford announcements said their vehicles that drive on the Tesla standard won't be available well into 2025. So we have quite a bit of headroom on that. And we have quite a bit of time to structurally adjust in the industry and make sure we have adapters and other methodologies to ensure that all drivers, regardless of the auto OEM they choose to purchase their EV from, can charge.
Brendan, I've got to ask you, what do you need from regulators to help with the expansion of EV and support your business?
So I think the Biden administration's done a lot. If you look at the $7.5 billion they've set aside, $5 billion of that is for highway DC fast charger infrastructure, and the other 2.5 is for community and rural. That's a great start. But what the policy needs to do is they need to work on a state and federal level to collaborate with industry, companies such as Blink, and help us and help the community install EV everywhere. And what we have to understand is for the greater driving public, their vehicle, according to the Department of Transportation, sits 95% of the time. The best way to charge those vehicles is inexpensive L2 charging. And that type of charging can really take care of most of the needs. And then DC fast charging along the highway or other convenient locations will fill in the gap. And what a DC fast charger does, it shows someone that here's a charger. It's a very visible sign. And it builds that antidote for, as you call it, range anxiety and creates range confidence. But L2 chargers do the same thing. So we'll collaborate. Policymakers are doing a lot more these days. Our level of collaboration on the state and municipal level is off the charts. The Biden administration is working hard. We're going to come together on the Tesla and the new standard as well, and we're going to keep driving the industry forward.
Yeah, Brendan, I mean, when you look at where things are in infrastructure, it feels like one big puzzle right now. We've heard over and over that at least in its current state of EV adoption, most drivers do charge at home. You want to expand that pool. A lot of people live in their apartments. They don't have chargers back at home. What's the conversation like right now with the utility companies and how much the grid can support it once you get wider EV adoption? Because a lot of people are going to want to charge at night. You don't have enough power to really source all of that, right?
Yeah, so it's very collaborative. And what we have to do is understand that the new home, as we talk about EV drivers, it's the single family, it is the multifamily dwelling, It is the municipal garage. That's where they park to charge the vehicles that they own. So we have to work with utilities and software companies, develop load management software that helps ease the load. And we have to make sure that we have timing that is reactive to the charging, that is reactive to the grid and the needs of the grid. And then we have to bring in new energy management technologies. Some of those technologies will be new devices that help spread the load evenly. Others will be battery-backed systems, would take the reliability of it, which help companies mitigate having overload on the grid. But to keep in mind, the U.S. as a power producer has plenty of power. What we need to improve is how we distribute that power. There's no issue with how much we can produce.
Brendan, I want to ask you about the government and postal service. We know that you got a deal to supply the charging capability for the postal service. There was talk originally about turning the postal service into a 100% electric fleet. There had been some backpedaling on that. Where does that stand now?
Well, so right now, the total order is 41,500 for 3 companies that are engaged in it. Blink is happy to say that we've already delivered and exceeded expectations on the initial delivery for the post office. And we're working on what the next steps are going to be as we move into January and February of next year. So 41,000 chargers for one agency is massive. And those chargers, as discussed before, are level 2 chargers. For the post office, that's the most economical way to make sure their drivers have a fully charged vehicle at the beginning of the day. That charge has enough to maintain their duty cycle during the day, and then they come back in, they plug back up, and they charge. So we're confident that other federal agencies are going to begin to look at the post office and say, we need to do the same thing, and that's great for Blink.
Blink Charging CEO and President Brendan Jones, it's good to have you on today. Thanks so much for your time.
Absolutely. It was great being on. Thank you.
It is closing time here at Yahoo Finance. Here's a look at what to watch for the week ahead. Fed Chair Jerome Powell on the hot seat. He's set to testify before Congress. On Wednesday, he'll testify before the House Financial Services Committee. And on Thursday, the Senate Banking Committee. Markets will be watching closely. They'll likely face questions on the Fed's pause this week and his outlook for the economy.
And while markets are closed for the Juneteenth holiday on Monday, there are several key economic reports to watch over the course of the week. The housing sector is certainly going to be a big focus here, with housing starts out on Tuesday morning and existing home sales due on Thursday. We'll also get the weekly read on jobless claims on Thursday.
And the earnings calendar is light, but FedEx will be a key company to watch. The shipping giant reports on Tuesday after the closing bell, and it's often seen as a look into the health of the consumer and spending. Earnings are expected to decline from a year ago as demand pulls back from pandemic highs. The company is also working on a restructuring plan, and one analyst from Jefferies says all eyes are going to be on guidance for fiscal year 2024 and warn that if numbers are overly optimistic, that could be negative for the stock.
And that does it for Diane and I on today's Yahoo Finance Live. Be sure to come back here on Tuesday, 3 p.m. Eastern. We've got all of the market coverage for you there. Have a good weekend.
Have a good weekend and happy Father's Day to all the dads out there.